right, let's bring into the conversation our friend there at the American Institute for Economic Research, Lydia Mashburn-Newman. She joins me. Lydia, good to see you here. Thanks for being with us a little later. Let's get right to it. I want to pose this question. So interest rates today, unchanged. He's holding them steady. Powell is. Is Powell and the FOMC, are they being too cautious in your view?
Well, according to Governor Mueller and Vice Chair Supervision Mickey Bowman, they would say that the Fed's decision today was too cautious. And a lot of that has to do with them seeing some weakness in the labor market. But if you look at the other economic data, including GDP, but also inflation, the Fed is still has still not reached its 2% inflation target. We're hovering closer to 2.5 to 3%, which may seem only slightly off base, but that does compound. And so I think the Fed, and the general consensus of the Fed is that they still need to wait and see. And I think it's important to look at that inflation data in more detail. And we get new numbers tomorrow with the personal consumption expenditures coming out tomorrow. So we'll be looking closely to see what materializes.
Yeah, the PCE report you're referring to, that's the Fed's preferred gauge of inflation here. Let's go back because we're throwing around a lot of terms for viewers that might not be familiar. The FOMC, what is that? It's not just Powell sitting in a throne making decisions, right?
Yes, forgive me. Yes, the Federal Open Market Committee is our rate-setting body at the central bank, the Federal Reserve, and it is comprised of the 7 members of the Board of Governors that are appointed by the President and confirmed by the Senate, as well as 5 of the regional Reserve Bank presidents, one of which is the New York Fed, and the other 4 rotate between the other regional Fed presidents. And so that 12-member body makes up that decision-making committee.
And you alluded to this, which we can describe how unusual it is, because it is, that 2 members of the Fed board dissented here with the decision to leave rates unchanged here. How unusual is that?
So to have 2 board members dissent, the last time we had that take place was in 1993, so over 30 years ago, to have 2 board members dissent. Dissents have typically come from regional reserve presidents. We had several dissents, especially in the wake of the global financial crisis, because there were more disagreements over the stance of monetary policy. But having that dissent come from the board itself is quite a bit unusual. But I think it's important to remember that dissent is not necessarily a bad thing. I somewhat view it as a little refreshing. We've gotten so consensus-driven that there is some concern that the consensus isn't necessarily collaboration and consensus, but more of groupthink. And so even Chair Powell commented that this meeting, where there was much more robust discussion about the drivers of inflation and employment and the Fed's dual mandate and how to achieve it, he said that this was one of the, quote, better meetings that they've had because of that level of dialogue. And we would like to see that because the economy warrants that level of critical discussion.
So let's talk about how maybe tariffs are weighing into this decision here. Powell said this: higher tariffs have begun to show through more clearly to prices of some goods, he says, but their overall effects on economic activity and inflation remain to be seen here. So still a little uncertainty about the tariff question. He goes on to say, a reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. So he is, I don't want to say hedging, but he is intimating that it could be just a one-off, that this will not be persistent throughout 3, 4, 5 years as far as the impact to us, the consumer.
Exactly. So typically this tariff is typically a one-time price increase, a hike in the price of goods. You implement the tariff, and that is a tax that adds to the total cost of the tariff. It is not typically inflation driving. It is inflation requires a general rise in the price level over a period of time continuing. And so Powell is correct that this normally would result in just a one-time price increase. And we've seen some of that in some of the areas where the tariffs have come into effect, some in the home goods areas, especially in apparel, that have already kind of been in place. And so it's not unreasonable to say that the Fed should look through that, because the Fed actually can't fix a one-time supply shock. What he's supposedly more concerned about is whether that one-time supply shock would result in other shocks either from more tariffs or that it would unanchor inflation expectations in the economy for more inflation to come down the pike later. And so that's the thing that supposedly the Fed is trying to wait and see before reducing rates. I think it's also important to acknowledge, though, that there are other drivers of inflation aside from the tariffs. We're still wringing out some of the drivers of the pandemic-induced inflation from the pandemic monetary policy, including things like the money supply, which is one of the key ways in which monetary policy leads to inflation. Money supply is now at levels that we were seeing right before the high inflation we saw in 2022. So there is reason for caution. And so too late Powell maybe isn't too late. Maybe he is just being cautious.
Okay. I want to talk about the second quarter GDP numbers. Better than first quarter. Remember, last quarter, there was a contraction of 0.5% here. Now it's being projected and expected 3% growth in the second quarter GDP. What should we attribute that to?
That's a great question. So if you look under the hood of the GDP numbers, it is largely driven by a decline in imports. And that is arguably due to the tariffs. And imports are a negative, a subtraction from our GDP calculation that is made up of consumption spending, government spending, investment, and then a term we like to call net exports. And so we saw imports decline and exports also declined, in fact. But because imports declined so much, that made the rest of the GDP equation look much higher. Whereas the prior quarter, there was a lot of importing in advance of the Liberation Day tariffs, and that actually drove GDP way down. And so a lot of economists and analysts are saying that this really is just the tariff effect going on, and that we really need to look carefully at the other components.
Yeah, that's so interesting. I think from a non-economist perspective, that may seem, counterintuitive, just kind of that formulation there about what goes up and what goes down and the after effects of it here. So I was, struck by the fact that we're all speaking about what's going to happen Friday, August 1st, as these tariff extensions, these tariff delays are no more. I mean, President Trump said they're sticking to that date. We also got news today that yet another trade deal has been struck with yet another nation. I'm talking about South Korea here. If we can put that post up on Truth Social, I'll read that. So what are you anticipating for Friday? What's going to happen?
So we have seen a number of major trade deals come into fruition. You had the EU deal, the Japan deal before that, and now we saw the deal with India, and now this new one with South Korea. So these are some of our larger trading partners aside from Canada and Mexico. And so that is some progress that helps reduce the uncertainty that the marketplace has been experiencing. But there are a lot of other concerns still at play. For example, tomorrow, some of the legal framework that President Trump is using to implement these tariffs is actually due to be under court review tomorrow, I believe. And so there is some argument that even though he has this August 1st deadline, the U.S. courts may actually make a decision not in his favor and could trump Trump's deadline. And so there's definitely a lot to continue to pay attention to, although the certainty for sure will lend itself to improved economic conditions, even if we end up with higher tariffs.
Yeah, just kind of the 30,000-foot view on tariffs overall. There was a piece I referenced with one of your colleagues yesterday in the Wall Street Journal, essentially making the argument that there have been no costs borne by the United States for waging this tariff trade war, that we have given nothing in return. The kind of thrust of the piece is that it's been wholly beneficial other than that very, very short-term shock in the market after Liberation Day on April the 2nd. The Trump administration, live pick there at the White House, touting that they have received